All right. Welcome, everyone, to the fall round of our sessions in the Elder Law Training Series presented by Pro Seniors and the Ohio Department of Aging in collaboration with the Ohio Training Advisory Committee of the Alliance of Ohio Legal Aids. This is our final session in this series. We've had 9 sessions over the course of the year. This is our final 9th topic that we're covering today. We will have the link in the chat in just a moment that takes you to the folder of all the past recordings and materials. You'll also find a subfolder in there that says reverse mortgages, and it has the PowerPoint for today. So if you want to open that up and follow along with our trainers, that's where you'll find the PowerPoint. Later today, we'll also put the recording for this session in that folder. So if you have folks in your office that weren't able to make it, let them know that the recording should be available by the end of the day today. If you are an attorney seeking CLE credit for this session, please answer the polling questions when they pop up during the presentation. If the polling question box isn't working properly for you, just put your answer in the chat and we'll log your answer that way as well. At the end of the session, there's a survey that will pop up. Please do that again if you need CLE credit, although we welcome survey input from everyone. And when we send the follow-up email, we'll also have a link to that survey if you miss the pop-up window at the end. During the session today, if you have questions, please put them in the chat. We'll be monitoring that and let the speakers know when those questions come in. And they will do their best during breaks and at the end to get your questions. But if you have follow-up questions that we need to answer later, we will relay those to the presenters. All right, with that, I want to welcome our presenters today. We have joining us again after a couple month hiatus, Miriam Sheline, who is the managing attorney at Pro Seniors, and she is joined by Aaron Campbell, staff attorney with Pro Seniors as well. So I will pass it off to the two of you.
Thank you, Melissa. Good morning, everyone. Thank you again for having joined us through our series. Hopefully the series has been of help. We're going to do something a little different today when we're talking about reverse mortgages. We're going to do a little tag team between me and Aaron. Hopefully you found out that I'm not the only one who knows things here in the past 3 or 4 presentations. But last but not least is going to be talking about reverse mortgages, which is, of course, a pretty unique senior issue. For the attorneys in our group, it is, because it's a federal program, it's very regulatory heavy. So hopefully our PowerPoint is going to be available to you to pretty much put you in touch with where to find regulations, where to find the statutes, where to find the HUD handbook, etc., for references as you need. So we're going to get into the nitty gritty about reverse mortgages, but let's get started with what we already have heard.
Look, this isn't my first rodeo. And let me tell you something. I wouldn't be here if I thought reverse mortgages took advantage of any American senior. Or worse, that it was some way to take your home. It's just a loan designed for older homeowners, and it's helped over 1 million Americans. A reverse mortgage loan isn't some kind of trick to take your home. It's a loan, like any other. Big difference is how you pay it back.
Find out how reverse mortgages really work with AAG's free no-obligation reverse mortgage guide. Eliminate monthly mortgage payments, pay bills, medical costs, and more. Call now and get your free info kit. Call 1-800-747-4294.
Other mortgages are paid each month, but with a reverse mortgage, you can pay whatever you can when it works for you. Or you can wait and pay it off in one lump sum when you leave your home.
Discover the option that's best for you. Call today and find out more in AAG's free no-obligation reverse mortgage loan guide. Access tax-free cash and stay in the home you love.
You've probably been investing in your home for years, making monthly mortgage payments, doing the right thing. And it's become your family's heart and soul. Well, that investment can give you tax-free cash just when you need it.
Learn how homeowners are strategically using a reverse mortgage loan to cover expenses, pay for health care, preserve your portfolio, and so much more.
Look, reverse mortgages aren't for everyone, but I think I've been around long enough to know what's what. I'm proud to be a part of AAG. I trust them. I think you can too.
Trust AAG for the best reverse mortgage solutions. Call 1-800-747-4294 so you can
Retire better.
Okay, now we're hit escape.
Look,
There we go. Sorry, a little tech there. So all sounds great according to Tom Selleck, just perfect. And of course, you're going to get this free disclosure kit. But of course, what we're going to discover through this presentation is, as Paul Harvey used to say, the rest of the story. First of all, with regard to trusting AAG is probably is the biggest reverse mortgage lender in the U.S. And lo and behold, in 2016, the AAG and 3 other lenders got tagged for deceptive disclosures in their materials that seniors could not lose their home, for instance, or that they would be able to pay off all their debt or stay in their home for the rest of their lives, etc. They entered into a consent order in 2016 to basically clean up their advertising, and that should have been the end. But guess what? In 2021, AAG was cited again for their deceptive marketing practices in violation of that consent order, but also now inflating home values and home estimates that they were making as to what you would be able to access through a reverse mortgage. So, also an article from USA Today about seniors who were sold these products, and what was discovered. Not only the still can and are put into foreclosure because of these reverse mortgages, but reverse mortgages ended foreclosure 6 times more often in predominantly Black neighborhoods, especially for residents making less than $40,000. All right, so here's just sort of our roadmap as to what we're going to cover in the next 90 minutes. Okay. As we said, we're going to do a tag team. I'm basically going to cover through 1 through 8 through those slides. And then we'll have a poll question, and then we will switch to Aaron, who will cover the next several slides up to 16. I will cover number 16 on set-asides and leases. Then Aaron will come back to do 17 through 22 on Medicaid considerations, and then I will wrap this up. Sort of as Melissa suggested, feel free to put your questions in the chat, probably at the time that we are switching speakers. Each of us will take questions at that time. So feel free to put those in as you go along. And let's get going. All right. So start with the basics. What is a reverse mortgage? Okay. This is a special type of home loan which allows homeowners to borrow money against the equity in their home. Sounds great, but again, unlike a traditional mortgage, the reverse mortgage does not require payments. It is paid when the borrower or co-borrower and eligible spouse sell the home, they move out, or they die, assuming there is no other default. Okay. It is what we would call a non-recourse consumer credit obligation, so it is a debt. You are essentially turning the equity into your home into a mortgage, just like a traditional mortgage, but you are paying that mortgage back, and the interest and the fees, et cetera, accrue on top of that mortgage as the obligation exists. Because it's non-recourse, you cannot go after the consumer personally. Okay, the remedy is limited to the proceeds of the sale of the house. And if there was a recourse situation, then we would have TILA problems, okay, with a balloon payment. So, as I said, how it works, the principal, the interest, and what they call the shared appreciation or equity, which we'll talk about later, is not due and payable until the consumer dies, the home is sold or transferred, and the consumer ceases to occupy the dwelling as a principal dwelling for 12 months. Because it is a unique type of mortgage, there are required disclosures which the consumer must receive, such as the statement that they do not have to complete the mortgage just because they sign an application. They have to receive a good faith projection of the total costs of the credit, which includes all costs. There's got to be an itemization of the loan terms, the charges, who's the youngest borrower, the appraised property value, and a table explaining how those costs will accrue over time. So essentially, what you're talking about is that you start with the value of your home. You're going to be paying off any debt that be beyond the home, but then they're in calculating what we call a principal limit, again, which is what Aaron will discuss more about, is that the principal limit is based on what's the equity, where are all these expenses that are coming out over time, all the interest over time that's eating into that principal limit, set against the projected increase of the value over your lifetime. Okay. And how does that work? As we will see, that principal limit starts off small and gets smaller over time until it doesn't exist. Okay. What kind of reverse mortgages can you have? You can either have a home equity conversion mortgage, which is insured, and there are proprietary, sort of private home equity loans, which are not insured. Generally speaking, the vast majority are insured home equity mortgages. So how did this come about? It started in 12 U.S.C. 1715 Z20. Congress established this program to help elderly homeowners to convert equity in their homes to a supplemental income stream. And you'll see the statutes and the regulations cited there. There's also a HUD handbook, which we will reference a little later in the materials. So its statutory purpose is to meet needs of elderly homeowners who are at least age 62 by reducing the effect of economic hardship caused by increased health costs, housing costs, and subsistence needs at a time of fixed or reduced income, allowing the conversion of home equity into a liquid form so that they can meet those additional needs. And of course, then the home equity conversion mortgage is insured so that it meets the statutory regulatory terms of the program. So what are the initial requirements? You must be at least 62 at the time of closing. It must be your principal residence of everyone who's a borrower or even a non-borrowing spouse. And again, Aaron will get in the nitty gritty about the non-borrowing spouse, okay, exception, but essentially it has to be the principal residence. If there is a non-borrowing spouse, she must consent to the property services as collateral for the home equity conversion mortgage. No different than when we would normally do with a regular mortgage where you're waiving your dower, for instance. The mortgage has to be secured by a single family home, manufactured homes, condos, properties and planned unit developments, townhouses, and properties held in a living trust. So essentially, If it's still your principal residence, you are the primary beneficiary, but the property is held in one of these, estate planning kinds of trusts, it still can qualify for a reverse mortgage. Ineligible properties are co-ops, boarding houses, bed and breakfasts, and homes that don't have a HUD certification or a permanent foundation, and flipped properties. So essentially, the regulations on flipped properties is if you're turning around and reselling it within 90 days, or 180 days for, I think it was 100% of the value that you sold it for previously, it's not going to qualify. Okay. The property has to be owned in fee simple or by a long-term lease. Now, this is not a life estate kind of long-term lease. This long-term lease has to be essentially 100 years. You have to have marketable title. You have to have credit standing satisfactory to HUD. Okay, so the idea here that you can qualify simply because, hey, you're in a foreclosure and you've got lots of debt, so you want to use this as a tool to avoid foreclosure, may not work because you do have a credit standing requirement. Okay, there has to be counseling. Again, this is technical stuff, and even with disclosures, when Erin shows her examples, you'll see how mind-boggling those numbers could be. So there must be independent counselors, counseling session regarding this. Okay. And that counselor can't be associated with someone who sells annuities, long-term care insurance, or other financial insurance products. Reverse mortgage is not to be used as some financial planning mechanism of, oh, I'll take the equity out and make money through an annuity or something like that. Okay. I'm practically speaking, when you see the numbers, I don't think that would work anyway. But that was the concern with this. There has to be a full disclosure of all costs, and the lender has to be HUD approved. They have to have sufficient equity, not just to pay off any liens and mortgage on the property, but also any federal debts. There has to be sufficient equity to pay all the costs and fees, which includes any costs and fees incurred throughout the life of the HECM. Okay. The property must meet required property standards. So anyone who has dealt with FHA, essentially there can be interesting requirements for property standards. Although the borrower can make the required repairs, and we'll talk a little bit about that in a minute. The payments can be made to the borrower either on a line of credit that they can draw on as needed, or a monthly basis, over either a specified term or for the life of the mortgage, or over a combination of either. So prepayment, obviously you could prepay it in whole or in part. Can be made at any time without penalty. The borrower is not liable for the difference, okay? Because after sale, the government insurance takes the balance. Property standards. So the property must be habitable and safe. And that means meet HUD's property requirements or must be repaired. Now, if depending on the amount of the repairs, as long as the repairs do not exceed 15% of the maximal claim amount, essentially the principal limit, the money can be set aside to make those repairs out of closing. If the repairs are to be completed after closing, it has to be inspected by a HUD-approved inspector before payment. The funds would be released after final inspection and approval by the lender. And the lender will not reimburse the borrower for any labor the borrower performed. Okay. And that's going to be essentially a repair set aside. And we're going to talk about set asides a little later. But that's the essential. Again, we're talking about a pot of equity that's in this property that's not really a pot of money yet, but it's just, oh, this is the number. And now we're going to carve out a piece of each one, a piece for this and a piece for that out of that equity. Okay, financial requirements. Again, the lender's going to verify income, assets, monthly expenses, recurring monthly expenses, and credit history. So as I said, you would think that the issue is simply, oh, we're paying off the mortgage and they're secured by the rest of the property and you're not making any payments. So why is your credit history important? Because you still have obligations to pay the real estate taxes, property insurance. And so the borrower has to document the ability to pay those real estate taxes, property insurance going forward. So the lender has to do a financial assessment of the borrower's capacity to determine if this is going to be a sustainable solution. It has to be, not discriminatory standards. And that assessment includes, as I said, an in-depth credit history analysis under FHA guidelines to determine if the borrower has demonstrated the willingness to meet his or her financial obligations, and a cash flow and residual income analysis that determines the capacity of the borrower to meet their obligations with their documented income. Can they pay their bills going forward, even if we do this reverse mortgage? Now, if there's extenuating circumstances where the borrower's credit history does not meet the FHA guidelines, then the lender can document extenuating circumstances. And they have to identify what anything that would sort of offset, oh, well, this is going to be okay. All right. So counselors, how many HECM counselors are there? There are 2 in Ohio. Okay. One up here in Cleveland, the other one in Fairborn, which is basically just outside of Dayton, Montgomery County area. That's it. Your potential clients who want to look at a reverse mortgage must go through counseling with either one of these two groups. Now, because it's a reverse mortgage, of course, there are additional disclosures that must be made. Again, we mentioned this one before. They must have all costs of obtaining the mortgage as well as all costs of the ongoing costs of the mortgage. They have to make sure that the excuse me, that the borrower is aware, or at least the lender should be made aware of any costs or obligations the borrower has incurred to get this mortgage, i.e., have they paid a fee to a broker, for instance. And the lender has to tell them these charges are required and these charges are not. And then if they request 25% of that principal limit up front, the lender has to confirm it's not to be used to pay an estate planning firm. As when Aaron gets through the numbers, not sure this would ever be appropriate for estate planning, but I guess people could try to sell that. Finally, you can designate, because we are talking about seniors, you can designate an alternate individual who can receive communications in case the borrower is unable to be reached. It's totally at the discretion of the borrower. But then having been designated, then the lender can reach out to this alternate individual. All right, and here is our poll question number 1. When she puts it up here. Okay, so we have a little example there. Joan, age 65, is in foreclosure for default on her real estate taxes. She has no mortgage. there are no other liens on her home. However, she owes the IRS for back taxes and has defaulted on her credit card debt. True or false, a reverse mortgage lender will not consider her bad credit or IRS debt in determine if she qualifies because they are not liens on the home. True or false?
Okay, we'll give everyone a few more seconds and then we'll close the poll.
Okay, vast majority say false. That is correct. Okay, there has to be a financial assessment. Okay, and you have to pay off all federal taxes. Before I go away here, does anybody have any questions so far?
Don't see any in the chat at the moment.
Cool. All right. Well, I am going to go off mic and let Erin pick up. Thank you.
All right. Hi, everybody. We're going to talk first about a little bit more detail about the types of reverse mortgages. And this is not to be confused with the types of interest that might apply to reverse mortgages. I think it's kind of easy to mix these up. But essentially, the types of reverse mortgages first are, you have the option to receive monthly payments. And those could be defined by a term or by tenure. And a term would be if you agreed with the lender to receive payments for a fixed amount of months. And the nice thing about that is even if the principal limit exceeds the equity in your home or the value of the home, you would still receive the agreed to payments. Or you could opt for defined by tenure monthly payments, in which case the reverse mortgage company would assume that you would live to age 100 and would define how many payments you're getting based on how far you are away from 100. Or if you're older than 95, they would give you a 5-year tenure. Sometimes, borrowers might prefer term payments if they're younger, because then they can get more money up front, which is probably not the best idea in the world. But if monthly payments are attractive and you think you might only want to live in your house for a few more years, that might be an option you might be tempted to consider. I don't think that would personally be a great option, but that kind of explains the difference between those two. If you're on a 10-year plan, the payments continue until the mortgage becomes due and payable, unless the payments exceed the maximum mortgage amount in the security instrument. A few other options. There's a line of credit option, and this is where essentially some equity in your home called the principal limit is made available to you at times and in amounts determined by the lender, but you can't receive more money than the principal limit, which is set up per a HUD calculation. You could get sort of a mix of the two. So receive term and tenure payments and plus have a line of credit. Or there's a single disbursement, HECM. And I personally feel that this is probably the worst option because essentially you receive a small payment at closing and then don't have any access to the equity in your home after closing. That one, though, does have a fixed interest rate where all the other options, the line of credit and the monthly payments, are an adjustable interest rate. So it's one key difference there with single disbursement. Okay, so you can also, if you want, use a reverse mortgage to buy a home. To do this, you'd have to have enough principal to put into your home to then draw some out again. I feel like this is a terrible idea, but it's available. Your property does have to be habitable. Okay, so the principal limit is a key term. It's the amount of money you can borrow on a reverse mortgage. And how you get to the principal limit depends on 3 things. The first is the age of the youngest borrower or eligible non-borrowing spouse. So generally speaking, the younger the borrower or eligible non-borrowing spouse, who's the youngest, probably the smaller the payments that are going to be immediately available, either on a line of credit, or the smaller the monthly payments on a term or 10-year monthly payments. It also depends on the expected average mortgage interest rate, and then the maximum claim amount. And that is, the maximum claim amount is either the appraised value of the property or the sales price if you purchase your home specifically to put a reverse mortgage on it. And there's also a national mortgage limit. So if your house is worth more than $1.149 million, then your principal limit can't be more than that. For most people, though, just based on the target audience for reverse mortgage, the maximum claim amount is going to be the appraised value of the property. So the principal limit does increase over the life of the mortgage unless you have that single disbursement fixed interest rate mortgage. So for all the other types, the monthly, term and 10-year payments and the line of credit, your principal limit and how much you can draw out of the reverse mortgage will increase over its life. And it's a set formula that HUD provides. And if you have a adjustable line of credit, you will be able to access that increase in the principal limit. However, if there's insurance or condemnation proceeds that are paid out, so if maybe there's a disaster and your home has to be kept in good repair, that is a term of the mortgage. And if your lender has to satisfy that for you, then they're going to make a claim. If they then make a claim against that, that could decrease your principal limit. You don't get the principal limit right away because of the set-asides. There is sometimes a monthly servicing charge that the lender can charge you to service your reverse mortgage. They don't have to, but they can. If there is a lease set up, which Miriam will talk about in a minute, then that's where money is put aside to pay property charges like homeowners insurance, property taxes. That'll decrease how much you get out of your reverse mortgage. Or if there's a repair set aside, because under HUD regulations, improvements need to be made to your property, but they're not all going to be made by closing, and there's money set aside for that. That'll decrease your principal limit. Okay. So let's talk a minute here about interest rates. As I mentioned earlier, if you choose the single disbursement HECM to just get a little bit of money at closing, that'll have a fixed interest rate. And that's the only type of HECM that has a fixed interest rate. All the other ones have adjustable interest rate. And there's a couple types here. Your interest rate could adjust annually. And if it's an annual adjustment interest rate, it can't change more than 2 percentage points per year or 5 percentage points in either direction from the initial rate over the life of the loan. And these loans are going to be tied to one of 3 indices. The average weekly yield on U.S. Treasury securities, or one of these secured overnight financing rates. If instead you choose a monthly adjustable interest rate HECM, then it's going to be tied also to the same 3 indices. There's a cap of no more than 10 percentage point change from the initial rate in either direction for the life of the loan. There's no specific annual cap on these. But you and the lender could agree that those caps would be smaller. So that is certainly something to watch for when you're helping a client assess a reverse mortgage is what's the proposed cap look like. Okay, Miriam mentioned earlier appreciation sharing reverse mortgages, and appreciation sharing seems particularly terrible. So this would be if instead of a high interest rate, maybe the lender offered to charge you a lower interest rate, but said, well, to make up for that, we'll just share in your appreciation. Well, what does that mean? That means if your home increases in value, you have agreed to give the lender a percentage of the increase in value. And in this particular news article, the homeowner had a reverse mortgage. She died 2 years later and her children sold off the home. And what happened was, because of a few different factors, but the big one is this shared appreciation, the children, barely like, the children found out that their parent had been essentially abused. So they sold the home and found out that the reverse mortgage company was demanding $765,000, even though she'd only had this thing for 2 months and she'd only gotten $58,000 out of it. So how did she owe $765,000 at the close of the mortgage? Or I'm sorry, when the mortgage was due? And it's because of appreciation sharing or equity sharing. In this case, the lender required 50% appreciation sharing, and they lowballed the value of her home when they closed the mortgage. They valued it at $980,000, but actually it was worth $1.4 million about that time, according to the estate. So then when it was sold for $2.2 million, the lender was requiring half of that in shared appreciation. There were some other abusive facts with this, but it's just not worth it. So because of all this, the regulations have changed some, and if it's a HECA, appreciation margin is capped at 25%. And there's a formula for how you calculate this, and then another effective interest rate cap of 20%. But I would encourage you to advise your clients to steer away from these. So many of our clients live in areas where perhaps, there's a really good potential for appreciation of the value of their home, just because of the hot demand for homes, especially lower cost homes. And they could really be taken advantage of by this appreciation sharing. Okay, so once you, the lender, figure out what the principal limit is going to be on the house, it doesn't mean that you're going to get that full principal limit at closing. Instead, you're only going to get a portion of it called the initial dispersal limit. And you can only get a small portion for the first 12 months. This is probably meant to curb abuse and for people all of a sudden taking out a whole bunch of money at once right at the offset of their loan and then having nothing else later on. So the initial disbursement limit is the greater of either 60% of the principal limit, which is an amount set by HUD, or the sum of the mandatory obligations that must be paid at closing plus 10% of the principal limit. The only difference is if there's a LISA set aside. So if you have to set aside money to pay property taxes and homeowners insurance because of your poor credit worthiness, then you might wind up having to do another calculation for your initial disbursement limit based on those fees. So the mandatory obligations. So these are things that the homeowner has to pay at closing, and it's a lot. The first is the loan origination fee. It is set by regulation. So it should be similar. If you get quotes from multiple different lenders, you should see that the loan origination fee, it's a calculated amount based off of the appraised value of the home. There is a floor and a cap. The cap is increased annually. It winds up being a significant expense. There's also a mortgage insurance premium. You'll recall that HUD insures these loans. And if at the close or at the when the loan becomes due and payable, if there is not enough money out of the sale of the house to pay off what's owed on the reverse mortgage, HUD insures that. And so there is a hugely expensive mortgage insurance premium that is due at the outset of the loan and then monthly for the life of the loan. And that's also set by formula. You also pay a counseling fee for those services Miriam talked about to talk with a counselor. You have to pay repair set-asides up front, repair administration fees. So the lender can charge you an administrative fee to administer these set-asides to repair your house. If you owe federal debt, that has to be paid off at the close of the loan. That would be if you have federal tax debt or student loan debt, that's all going to have to be paid off before you can enter into a reverse mortgage. If you have an existing mortgage on your house, that has to be paid off at closing. Okay, also, any fees for inspections, surveys, engineers, certifications. If you have to pay contractors as a condition of closing, that's going to be paid at closing. And then reasonable and customary amounts, but no more than what the lender actually pays for just your standard closing things. So credit report, recording fees, title exam surveys, lender's title insurance, fees paid to an appraiser, and then flood certifications. And in addition, there's ongoing costs to reverse mortgages, and those are going to include monthly interest, which is a significant expense over the life of the loan. That, in fact, is where most of the principal in the loan is, or most of the equity in the home is going to go to that interest. There's going to be monthly servicing fees, potentially. Not all lenders may charge those, but you want to look for that on your quotes. And then monthly mortgage insurance premiums, these are also a significant expense. That's a formula amount that shouldn't change. So those costs are certainly going to eat up much of the equity in the home. So to continue to have a reverse mortgage, you do have to pay property charges, and those include property taxes, hazard insurance premiums, so your homeowner's insurance, ground rents. So if you own the home but you rent the ground, you have to pay that. Flood insurance premiums, if applicable, condo fees, HOA fees, other taxes. Okay, and that takes us to poll question number 2. So if you are assessing multiple quotes for a reverse mortgage, which is something that a potential borrower cannot price bear because it will be the same on every quote, assuming that the home is appraised at about the same amount. And the first is margin on interest, which I should explain. When you have an interest rate that's selected pursuant to an index, the margin on interest is the amount of additional interest the lender can charge. And that is something that varies. So you really want to pay attention to the margin that a particular lender charges. Monthly servicing fees, shared appreciation, and property taxes. So which one of those is something that a potential borrower cannot price compare?
Okay, we got about 75% participated. Give you a few more seconds. And there you go.
Yes, you all got it right. Good job.
There we go. It was not letting me out, or letting me back on. So any questions that you had for Aaron's section? I know it's Friday morning. I said this was going to be a little tech heavy.
I don't see any questions, Miriam, but just
Okay.
FYI, your camera, it looks like it's off.
Oh yeah, my camera's off. There you go. Okay. I'm back on. Y'all didn't want to have to see me anyway. So, all right, let's talk about set aside accounts. Okay. So I think you're getting the picture, and again, when we see the numbers, you'll see what's happening. But essentially, this principal limit is set after figuring these interest charges and deduction for those mortgage premiums and monthly expenses, etc., over the life of the loan. And then what's left, payment of everything, what's left might be your principal limit that the owner can actually access. although those expenses are added onto the mortgage over the life of the mortgage, it's still being taken off of your principal limit that you can access. All right. Another piece that's going to be carved out of that principal is what we call the set aside accounts. Okay. So the lender can set aside funds to a separate account for additional costs, such as more monthly service fees, repairs, property taxes, insurance for the first year of the loan. So I know Aaron talked about monthly service fees, and the question is like, well, they don't charge you monthly service fees on a regular mortgage because they're receiving their interest every month in your payment. That's what tends to pay for that monthly service fee. That's part of that interest cost. That's part of their profit. But realize that the interest that we're receiving on this case is not until the end of the mortgage, 10 or 15 years later. So this is where you will see frequently service fees they can charge to send you statements and to service the mortgage. Okay. And again, as Aaron sort of suggested, they can also have a set aside for repairs, as well as a service fee for each repair that is occurring after closing. Then we have what we call leases, which are life expectancy set asides. And these are going to deal with specifically property charges. And essentially, it is first premise, the borrower is to continue to have this obligation to pay property tax charges such as taxes, flood and hazard insurance premiums. Okay. But if that financial assessment we talked about before shows that they're unable to do so, the lender is required to carve out another piece of the principal limit to pay those charges. Now, if the borrower can pay the charges, they can elect a full or a partial LISA if they so choose. And we're going to talk about the different options with regard to that. But if that financial assessment shows that they are unable to pay those taxes and insurance, then a LISA is going to be required. So let's assume we're going to do what we call a fully funded LISA. So essentially what we're talking about is that, again, through a HUD formula, we're going to project the cost of property taxes and insurance over the life of the mortgage, and we're going to carve that out of that principal limit, okay, as a set aside. We're not actually putting money into an account, and you'll see that theme over and over again, that this is not an escrow account. It sort of sounds like it, but it's not, because it's simply equity in this real property, which we're sort of putting aside, and then when charges are incurred, are now added to the mortgage. Right? So for a fully funded LISA, the lender is to pay the property charges before they become delinquent and have controls to ensure they get the bills and get them on a timely basis. They are to take advantage of any discounts that the borrower might be entitled to. Again, think homestead, for instance. Not charge the borrower penalties if they cause the late payment. Okay. Add payments then once made to the loan balance, and provide the borrower and FHA with 30 days notice that the property charge is outstanding when the LISA funds have been exhausted. So what about a partially funded LISA? You could do that as well. In this case, however, all the lender is doing is sending a check essentially to the borrower twice a year, and the borrower is obligated then to make those payments. And once they make that disbursement, then they add that payment to the mortgage. Okay. If the LISA is exhausted, then they give the borrower an FHA notice within 30 days. Again, how they calculated it is basically with a HUD formula, using the life expectancy of the youngest borrower. Okay. They cannot require more than whatever that number is. And the fully funded is the projected cost of property charges. And again, remember, we are doing these calculations at the beginning. Sort of follow up with what Aaron was talking about. Yes, they are, your property value will increase, but that's based on a projection started at the beginning of your loan. It has nothing to do, it's not going to be changed simply because, oh yeah, the property value actually increased, much more than what was projected or much less. This is all the projection started at the beginning when the mortgage is created. Okay. It is the same thing with regard to property charges. They'll have a formula to say, well, we anticipate your property real estate taxes will increase X amount. We're going to calculate that over your life expectancy of 20 years, and then they're going to say this is the amount we're going to set aside. As we've all experienced this past year, real estate taxes in the last year or two have gone way more than 2 or 5%. That's not going to matter. Okay. It's based on this projection. Okay. So, they are to do an annual analysis to determine if the funds are sufficient. Okay. But the only purpose of that is say, do we have any money left in the LISA to pay that? If there is insufficient funds left in the LISA, then no, it isn't like, oh, lender, you calculated it, so it's up to you. Nope. Once the LISA funds are exhausted, the borrower is now ultimately responsible for the payment of those taxes. If there is no more funds in a fully funded LISA for an adjustable interest rate HECM, then it's back to the borrower, as I said, to make those payments. If the borrower does not, the lender can use anything that's left in the second pot, the principal limit, to pay outstanding property charges, and then notify the borrower, who is supposed to explain why they didn't pay it. But if there is no principal limit left, then the mortgage can be called due and payable. And of course, foreclosure can be initiated. If it's a fixed interest rate HECM, again, basically the borrower fails to make the property charges, the mortgage becomes due and payable. What about the partially funded LISA where there are funds? Recall that with a partially funded one, the lender is sending payments to the borrower, but it is the borrower to make the actual payment. And in this case, the borrower fails to do so, the lender can suspend those payments to the borrower and disperse the funds to pay any of the property charges that are behind, notify the borrower in writing, and pay outstanding property charges. And again, the borrower has 30 days to explain. If there are no remaining funds and the borrower fails to make the property charges, the lender can now invade the principal limit again to pay those. Once the principal limit is gone, however, they will get notice and the mortgage can become due and payable once again. All right, so let's assume the financial assessment does determine that the borrower can pay the property taxes and the insurance over the life of the loan. The borrower can still elect to choose to have the lender do so by withholding funds either from their monthly payments, if it's like a 10-year or a term annuity kind of thing, or by charging the funds to that principal limit. If the borrower elects to do so, however, at the beginning, They can't change their mind. And again, once the principal limit is reached, okay, then the borrower must start paying the property charges on their own. We re-emphasize again that none of these can put the funds into an escrow account to draw on. Essentially, all we're saying is this is going to be a draw against the equity. Okay. At which point, when they draw against the equity, they add it to the mortgage. But this is not a pot of money sitting somewhere in an escrow account. Okay. But again, obviously, if the lender is doing this, they must pay the taxes before delinquent and pay early when there's a discount, and analyze the withholding annually. If the borrower chooses not to have a LISA, okay, then they're responsible for the property charges. And they have to provide evidence to the lender that, in fact, they have paid those property charges as they accrue. If the borrower fails to do so, the lender can step in and make that payment if there is funds available from that principal limit, which they can do so. If it's an ongoing problem, they have to notify the borrower and HUD and ask the borrower for an explanation. If the borrower does not repay the lender, then the lender again can call the balance due on the mortgage. What if the loan balance is more than the home value? Okay, again, remember this is a non-recourse loan. So all they can get is the value or the proceeds from the sale, with the mortgage insurance paying the balance. So upon the death of all borrowers and the borrower's spouse, and again, Aaron's going to talk about the spouse, the non-borrowing spouse, you can sell the property and pay 95% of the appraised value to pay it off. So leaving 5% for the heirs. Not sure that makes it worth their time, but it is an option. Then just briefly, let's talk a little bit about loss mitigation. Like I said, we talked about failing to pay the property taxes, so they essentially call the balance due and look to start foreclosure. Okay. There is a provision for loss mitigation under the reverse mortgage. And that basically allows the borrower to correct the condition which caused the mortgage coming due and payable. So even though they've called the entire balance due, if the default was I didn't pay the property taxes for 6 months or a year, they can correct it by paying that off. However, the lender can require additional costs for reinstatement, including the foreclosure costs and attorney's fees, which can be added to the outstanding loan balance, assuming there's some left in the principal balance. However, they can refuse it if they've already done it in the past 2 years, if it's really not going to solve the problem, so that foreclosure is going to happen again, or it will affect the mortgage lien's priority. Repayment plan. This is a separate option. This can also include HOA fees. So let's say that you're paying your taxes, insurance, but you haven't paid your HOA fees. You can enter into a repayment plan with the lender, so that you pay those expenses over 60 months. And the question is going to be, is your surplus income going to be sufficient to pay that over 60 months? And even if it's going to consume more than 25% of your income, so long as there is a reasonable expectation of performance. And here's our site. I give you the link again to the Reverse Mortgage HUD handbook. on this slide. There's also a hardship exception. Attorneys in the office have used this. So if the borrower is at least 80 and has a critical circumstances, such as, illness, okay, or illness of a family member, something unique in that regard. You have to provide the servicer with documentation such as the doctor's note. The servicer will include that in its request to HUD, and if approved, then the servicer has to provide that same documentation every year to continue that deferment on the foreclosure. So, at this point, I'm switching over to Aaron. Before I do that, are there any questions so far? You guys are a real quiet group, so. I know it's Friday morning.
Don't see any.
I'm going to. Okay. Well, I will switch over to Erin as she switches her screen up here.
Okay, so I want to talk very briefly about due and payable provisions. And a key definition for this section is going to be what is an eligible non-borrowing spouse, because typically a due and payable status depends upon what's going on with the borrowers. But there was a lot of abusive practice where lenders were encouraging borrowers to have only the older spouse be the borrower on a loan to increase the amount of the monthly payments or increase how much might be available on a line of credit, which is going to happen. But then that's a problem when the borrowing spouse who's older passes away and the loan is now due and payable because the other spouse wasn't on the loan. So HUD came up with this eligible non-borrowing spouse. And if there's an eligible non-borrowing spouse, that'll defer due and payable status. It also will affect the amount of the principal balance, because that's calculated based on the age of the youngest borrower or eligible non-borrowing spouse. So it essentially stops that abusive practice from happening, ideally. To be an eligible non-borrowing spouse, you have to have been married to the borrower at the time the loan documents were signed and stayed married to them until their death, identified in the loan documents, and then have lived and continued to live in the home as their principal residence after the borrower dies or the borrower moves into a healthcare facility for more than 12 consecutive months and meet other HUD requirements. So this can be a problem if the borrowing spouse marries somebody like during the life of the loan. Like there's no protections for that person. So in a remarriage situation or a cohabitating situation, even those folks are wanting to get some counseling, consider potentially refinancing, and certainly consider future planning because of reverse mortgage that is not going to have protections for the new spouse or a new cohabitating partner. So the outstanding loan balance is due and payable in full when the borrower dies and the property is not the principal residence of the surviving borrower or an eligible non-borrowing spouse, or the property is sold and conveyed and no other borrower retains title. But they do, in this provision, consider you to retain title if you have any part of it in fee simple, leasehold interest, or a life estate. The outstanding balance is also due and payable if the property ceases to be the principal residence of the borrower for reasons other than death. So this is not the healthcare exception. And this is essentially, you're given about a 6-month window here where you can move somewhere else and it's not going to be due and payable. But there's no exception here for an eligible non-borrowing spouse. And then, of course, the 12-month exception for if a borrower moves into a healthcare facility because of physical or mental illness, and the property is not the principal residence of another borrower or eligible non-borrowing spouse. The loan is also due and payable if the borrower does not pay their property charges, so the property taxes we just talked about, or the homeowner's insurance, or if another obligation of the borrower under the mortgage is not performed. When the last borrower passes, if there is an eligible non-borrowing spouse, that's not enough. That eligible non-borrowing spouse has to do more. And I feel like this first requirement could be terribly difficult. Within 90 days from the death of the borrower, establish legal ownership or other ongoing legal right to remain for life in the property securing the HECM. Like, what if the house has to go through probate, or there's a will contest? It seems very difficult to assume that that is a reasonable time period for a non-borrowing spouse to do just when their spouse has just passed away. They also have to ensure that all other obligations in the loan document continue to be satisfied and ensure that the HECM does not become eligible to be called due and payable for any other reason. There's, in addition to this, an extra 30-day cure period. So if you run through your 90 days, the lender will contact you, and then you could ask for an additional 30 days to cure. Okay, we're kind of running low on time, so this section here, I think I'm going to skip, but this is essentially a section that discusses the terms and provisions that have to be in a HECM. The HECM has to be in a form approved by HUD. Most of this we have already talked about, and I am going to skip through that. And if a lender fails to pay you your monthly payments, or to make dispersals when you request under a line of credit, you should complain to HUD. They will investigate. If HUD determines that the lender is unable or unwilling to make the payments, then HUD will make the payments. They might put a second mortgage on your property, but they will demand repayment from the lender. Okay, so this is a recent example of a quote that my client recently received in the past couple months on her house for a reverse mortgage, and she gave me permission to share it with you all. So she's 75 and really wanted to stay in her house. We talked about many other options, but because her primary objective was to stay in the house, she decided to explore reverse mortgages. She ultimately did not take a reverse mortgage once she realized how expensive it was going to be and how little she was getting out of it. But we did get a couple of quotes, and you'll see that essentially they quoted her 3 options. And because I thought it was highly likely that she will need Medicaid in the next couple of years, I said, well, why don't you need to really look at a line of credit. As opposed to the monthly payments. I'll talk about that in a minute, the implications for all this on Medicaid. But we decided to look at the line of credit options. So the first column essentially is the terms, but the first, quoted thing here, this HECM CMT monthly 5%. This is a line of credit option, and it is at an index that Common Treasury, I'm sorry. It was called like the average weekly yield of a U.S. Treasury security adjusted to the constant maturity rate of the year. So that's the index, the CMT that they're talking about here. And it says 5%. And what that means is that the change in the interest rate on this line of credit with an adjustable interest rate, indexed to that U.S. Treasury security, the changes in that, the adjustable changes in that are capped at 5%. And if you remember, the legal limit on that is 10%. But this lender decided to cap those changes at 5%, probably because interest rates were really high when she got this quote. And the lender foresaw that the interest rates were going to decrease. So to cut their loss, they capped the changes on this interest rate at 5%. The second column is another line of credit option, and this would be at the same U.S. Treasury rate, but if the interest rate adjusts annually. And the third option that they stuck on here is if she wanted the fixed HECM. So that if this, and remember, the only fixed HECMs are if you take that initial disbursement. And you can see as we go through this, this is pretty much the worst option. So the two adjustable HECMs are both fixed to the same index. And the second row down says margin or rate. And as I talked about earlier when we were doing the polling question, margin is the amount of interest in addition to the index interest rate that's tied to that treasury security. So that essentially is what's the profit in this for the lender. And that's why it's so important to look at that margin, because the interest is going to be the single biggest expense of the reverse mortgage. And you want that margin to be as low as possible. So when you're cost comparing, if you want to try to negotiate with a lender, the margin is really important to look at. So the margin on the monthly adjusting HECM is going to be 3.125%. It's higher for the annually adjusting HECM. It's 3.875%. And then for the single disbursement HECM, it's just a fixed interest rate that you would agree to with the lender. So they just picked 8.490%. And that is, of course, negotiable, or you could price shop, but they just picked it. It's going to stay the same over the life of the loan. There's no adjusting there. The next row is expected or initial interest rate. So you'll see for our first column, the initial interest rate is 8.245%. So that's going to be composed of the index rate plus the margin. And then that is expected by the lender to decrease to 7.605%. And that would, they expect that that's going to be the actual interest rate that they make as profit over the life of the loan. You'll see that the interest rate is actually a little bit higher for that annually adjusting HECM, 8.995%. But they do expect that that would adjust down to 8.355%. And of course, on the fixed HECM, it just stays the same, the 8.490%. They give you the interest rate cap, and you can see that that cap for both of the adjustable rate HECMs is 5% over the initial rate of interest. And then the next row, it says MIP rate. That's the mortgage insurance premium. So that is the rate of the monthly mortgage insurance that the borrower is going to pay for the life of the loan every month, so that the government will continue to insure this loan. And that is the same for each one of these three loans, 0.5%. Sometimes it might be 0.55%. I mean, that's going to be set by HUD calculation. And then they have the initial line of credit, the initial line of credit growth rate. And so that's what they perceive that the principal limit is going to grow at. And I'm actually going to take you down to the next slide, because I did break this up into parts so you can see this a little better. Kind of continuing down on this, this lender appraised the property as being worth $250,000. That was based on the agent for the reverse mortgage company looking at Zillow, not on any true assessment of the property. And this is where it can get abusive, right? Because like all the numbers on what the client is going to get out of the reverse mortgage are going to look better if the property is appraised higher. And, you know, he's deciding her property is worth $250,000 without even going out and taking a look at it or really knowing what the actual appraisal is going to come back at. So, you know, the borrower is going to have stars in their eyes potentially on like how much they're going to get out of this, and it not being realistic. So that's really something borrowers need to keep in mind. And then the principal limit, so how much equity in the home will be made available to the borrower is different for each one of these types of HECMs. It's going to be $93,000 for the monthly adjusting HECM, $86,000 for the annually adjusting HECM, and $85,000 for the fixed rate HECM. But they're not actually going to get that, as we'll talk about. But keep in mind, as I said earlier, the principal limit is that calculation based on the age of the youngest borrower, the appraised property value, and the mortgage insurance rate. So the higher the property value, and the more they can potentially get. Same if the borrower is older, they can potentially get more. And then also, the higher the interest rate, the lower the principal limit. And that's why the principal limit is lower for the annually adjusting HECM, because that has a higher interest rate. Okay, each one of these, each one of these requires purchase of mortgage insurance. And we saw the quote for the monthly mortgage insurance amount, but there's also a huge upfront payment. It's $5,000 for each one of these HECMs that has to be paid at closing. The origination fee is also set by HUD calculation. It's huge, $4,500 at closing. Other fees, I would expect that this is lowballed. They don't really know. Like, this is the time of the initial quoting. They don't really know what the other fees are going to be. But those are mandatory obligations that we talked about earlier, such as like getting the credit report, getting the title insurance, getting the survey done. They're estimated here as about $3,000. I would expect that those figures would probably go up by the time of closing. And then there's an amount for lien payoff. In the case of my client, she had an existing mortgage on her house on which she owed $40,000. So most of the available funds at closing are going to go to pay off her existing lien. If repairs were required, those would have to be paid off in addition. And in her case, they probably were going to be required because of the condition of her house, but that was unknown in this initial quote. And perhaps if there was other credit card debt or other debt and HUD was going to require that to be paid off, that would be in here too. My client didn't have any credit card debt, so that's not quoted as being something that had to be paid off. So the available funds for the first, for the first year of the loan at closing, for the monthly adjusting HECM were $41,000. And if you remember, this is that the whole calculation of, how much are you really going to get is the initial disbursement limit is based on either the larger of 60% of the principal limit or the mandatory obligations. So the lien payoff, the fees, the origination fee, the mortgage insurance, plus 10% of the principal limit. So in this case, the initial disbursement, the greater number was the mandatory obligations plus 10%. So for the monthly adjusting HECM at closing, after paying all these other things off, she would get $9,000. For the monthly adjusting HECM. For the annually adjusting HECM, she would get a little bit less, $8.6 thousand. And then for this fixed rate HECM, all she would get is this $8,575 at closing. So she would get her liens paid off, she'd pay, and then she'd pay essentially $9,500 out of her equity to get back $8,575 at closing, which seems like kind of a raw deal, because then she'd be paying interest and mortgage insurance, for like the life of the loan, just to get back less than what she's giving at closing. So that's why I think this fixed rate HECM thing is pretty bad, because then she gets nothing else out of her house until she sells it. Then they did give us here available tenure. So I'm assuming those would be the monthly payments that would be available if she picked a different option, like the monthly payment option. Okay, so what's going to be dispersed at clothing? Here, she hadn't really told us how much she wanted at closing. If she said she wanted cash at closing or a monthly payment at closing, they would have put it in here. Her line of credit, the additional line of credit she gets after the mandatory obligations are paid off is $41,000 under the monthly adjusting HECM, $34,000 on the annually adjusting HECM, but she would only get a portion of that, about $9,000 for both, during the first year. And then they give us this additional detail. They reiterate the mandatory obligations and the initial dispersal limit. They tell you again what that 10% that you can get over the mandatory obligations on your initial disbursement limit would be. And then UPB means unpaid principal balance. And so here, that amount would go up over the life of the loan as additional monies are allocated out of the principal balance towards interest and mortgage insurance and draws on the line of credit. But here at closing, because she's not taking any cash or hasn't said what kind of cash she wants to take, they've just put in essentially the mandatory obligations and the additional 10% as the unpaid principal balance. Okay, and then if you remember, there's a requirement that they have to give you this lovely chart. And I think this chart really gives some great information of what you can expect to see over the life of the loan. So year zero, in the first row here, year zero, my client is age 75, it's at closing. Her loan balance is going to be $52,000. So that's the mandatory, essentially the mandatory obligations she has to pay at closing. Paying off the lien on her house that exists and paying the loan origination fee and that mortgage payment. Initially, they didn't require a LISA, so they would have, if they had said, yeah, you need a LISA, that would have been quoted in here. There's no. I'm kind of jumping back and forth here, but the MIP column, the first year you didn't pay that because she had to pay that large amount at closing. There's no interest due at closing. She has a line of credit of $41,000, and then they give you the principal limit. And the principal limit is going to be the combination here of the loan balance plus the line of credit because she doesn't have a LISA. They're estimating again that her property value is $250,000, and then they give you the figure of equity that she's got in her house. And then every year, I also want to admit that this lender wasn't charging a servicing fee. So the third column over, SVC fee, this lender is not charging her one, which is helpful because those charges would also add up. So, we're going to use year 12 as an example year. So I've highlighted the row for year 12. Year 12, she'll be 87 years old. By this point in time, she's going to be paying annually $660 for her mortgage insurance premium, which has increased over the years. This particular year, she'll be paying out, she won't have to write a check, but she'll owe for this year $10,000 of interest, and that's increased. So, in year one, she only owed $4,000 of interest, but now as the property values are increasing, she now owes $10,000 of interest for this year. Her loan balance is $137,000. So it went from $52,000 to $137,000, and it's increasing so much because every year the unpaid interest is going into the loan balance and the mortgage insurance premium is going into the loan balance. However, her line of credit is also increasing. So her line of credit by year 12 is up to $109,000, which means, she could draw some more money out. And you'll see that the line of credit, the amount of that increases over time. So in year one, it only increased by about $3,000, but here by year 12, it had gone up $9,000 from the prior year. And the reason this line of credit is and the loan balance. Okay, the reason it's going up so much is also because they're estimating the property value is going to go up. We're almost out of time, so I'm going to go buzz through this super fast. She did get a second quote. It's on the right side here. You'll see that the big difference is that the margin was less on the interest. So the second quoter, reverse mortgage company, did not give her the table, but we did know that this second quote at reverse mortgage would be much less expensive to her in interest because they weren't going to charge her as much interest because the margin on the interest was much lower. A lot of the other differences in the figures are due to the fact that they initially appraised her house to be $260,000 under the second loan. Medicaid, I would say that key point on Medicaid is that a reverse mortgage is a loan. Money an individual borrows is not considered income, but if you retain the proceeds of a loan in the month following the month of receipt, then those proceeds will be considered to be a resource. So for Medicaid considerations, if you're going to do a reverse mortgage, definitely get a line of credit reverse mortgage where you're not required to take those monthly payments that you might not be able to spend. A LISA should not be an issue. There's no Medicaid regulation on point, but it's essentially a principal that you're borrowing out of the value of your home. So there's plenty of arguments that a LISA itself should not affect Medicaid eligibility. And then poll question number 3 is, what type of reverse mortgage is best for a potential borrower who is already on Passport Medicaid in-home waiver coverage? A monthly payment defined by term, a monthly payment defined by 10-year, line of credit, modified term or modified 10-year where you're both getting monthly payments and you have that line of credit, or single disbursement. Which one of these would be best if you're on Medicaid or Medicaid is in your future?
Okay, and so Erin and Miriam, we have a couple questions. We'll let everyone get through this poll. We'll give you a few more seconds. We got about 80% responded to the poll. And then once we're done with the poll, we'll be at time, but if you two don't mind sticking around for just a couple minutes, if there are questions, is that okay? I'm gonna end the poll. And there are the results.
Good job. I know I didn't talk about that nearly as much as I wanted to, but yes, the line of credit is the best option for somebody who's on Medicaid so that you don't have the concern of, not being able to spend the monthly payments and then those counting as a resource if they accumulate. The single disbursement is a problem if you take the single disbursement and then it's sitting in your bank account, keeping you over the resource limit. And then I see there's a question. Will the consumer homeowner owe a fee for obtaining these quotes and workups? How much is that fee, with any? There was no charge for that. So, I mean, these reverse mortgage, like, they really want to get you in the door. They are going to try to make it as easy as possible for your client to sign up for a reverse mortgage so that they can take a huge chunk of the equity in your house. So yeah, no, you shouldn't expect to have to pay anything up front to start the process of getting these quotes.
And there was one more question that came through on email.
So to just wrap this up, okay, as you see from those practical examples, all right, just boil it down, right? Her home is worth $250,000. But after payment of everything, $250,000, she had a $40,000 mortgage available to her through a traditional sale of somewhere around $200,000. Through a reverse mortgage, all that's available to her is $41,000. If she uses any of that up, then there's nothing available. Obviously, it grows over time if she doesn't use it. But essentially, if that's what you're looking at, those are the real considerations. Make this even work, you must have at least 50% or expect with no liens, 50% of it is going to go to interest, costs, fees, etc. So what are we when we're talking to our consumers on the helpline or otherwise? Okay. Things to caution them about. Number one, reverse mortgages have fees and interest that is repaid it's just repaid at the end. And obviously those are going to pile up over time. There is a federal insurance guarantee that the borrower pays for, but it is not a government benefit. Okay. It is something that you are paying out of the value of your home. The statement that you can't lose your home is incorrect. If you are unable to pay your property taxes or homeowners insurance, or you leave your home for longer than 12 months, you can fall in default and they can foreclose. And they have. People have lost their homes through these foreclosures. Simply because you have you have this equity does not mean that all of your expenses are going to be paid. You need to have a financial plan because you may live longer than the loan money will exist. Certainly, as Aaron indicated through that chart, sure, the line of credit will increase unless you've used it, which is what we tend to see. Are there alternatives, traditional alternatives? Taking it, if you're going to do a reverse mortgage later in life is probably better. But if you do it early on a fixed income, those real estate taxes and insurance may increase greater than your income. A home equity line of credit, obviously there is usually at a higher interest rate, but it's going to be a lower servicing fee, lower costs up front, lower costs than a reverse mortgage, but you still have to make monthly payments, and it's usually at a higher rate than say a traditional mortgage. Refinancing your current mortgage could lower your payments. There are additional closing costs, not as much as in a reverse mortgage. Lowering your monthly expenses. Are there other programs that can provide assistance that can lower your expenses overall? Increasing your income, possibly a landlord tenant situation. Obviously, that has its risks as well, as we know in our world. And selling and moving to a more affordable home. Okay, so as I started, in our client situation, her house is worth $250,000. She pays off the mortgage. She pays off the closing costs. She ends up with $200,000 versus 41, right? So, is it something where she takes that 200,000 and buys a less expensive home, which is also paid off, and puts aside the excess? Financially, that may be the best option. So this is something the clients just need to consider and weigh, and not be sold on, oh, your reverse mortgage will allow you to stay in this great home. Okay. There is assistance with the CFPB as well. If for some reason they're having problems with the reverse mortgage, here is the link and also phone numbers where you can file a complaint so that the CFPB will work on resolving those. And these are links to additional sources that we have referenced or cited in our presentation that you can get basic consumer information. So, sorry, we are 7 minutes over. But again, thank you very much. Just a reminder about our helpline, okay? Our Mid-American Pension Rights Project, and again, our Senior Medicare Patrol for those. These are volunteers who work on Medicare fraud issues. And anyone who is aware of private attorneys who would like to get referrals from our helpline attorney, that is the link for that as well. It is statewide, so we're always looking for statewide attorneys, whether for legal aid, as any of your VLB attorneys, etc., who are looking. These are not pro bono referrals. These are referrals of paying clients usually. Okay, so thank you again for all your attendance. Again, my apologies that we're over, but hopefully this series has been helpful to all of you on highlighting some of the legal issues specifically related to our elder population.
Melissa, did you say there was another question?
Yes, there was just one more question in email. So if folks need to go, thank you, Miriam and Aaron. We appreciate your presentation and thanks everyone for joining us. But if you have a minute, Aaron and
Yes.
Miriam, if you could, it was just a question about, do homeowners really have any power to limit shared appreciation to below 25%?
Yeah, I think you certainly just go find. I mean, there are so many of these reverse mortgage lenders. If the first lender gives you a quote that includes shared appreciation, I would very quickly call another lender and tell them, you know, hey, I got this quote. It's terrible. You know, I really just want to see what my options are. And chances are the second quote will be much better. Won't include shared appreciation. Neither of the quotes that my client got had shared appreciation in them. So unless that was something they were going to spring on her, which I guess is possible, these lenders. But neither of the quotes she got had that. And the second quote she got, as I talked about earlier, it had a much better margin. So I think that if you are considering, or your client is considering something as serious as a reverse mortgage, it makes a whole lot of sense to get multiple quotes from multiple lenders so that they can get the best deal possible in what is probably a terrible deal.
Yeah, it looked to me like the shared appreciation was financial freedom, which was, you know, one of the starting lenders in this business and isn't around any longer. Right. So it is not a mandatory part of any reverse mortgage, and obviously disfavored. But you could see that with housing prices, you know, going up exponentially at this point in time. You could see that being tried again. And if that were the case again with their counseling sessions, et cetera, I would be saying, flag, don't do that. Look elsewhere if that's what they're proposing, regardless of the cost.
Okay, I think that's it for questions.
Do you have any other questions? All right. Again, thank you for
Take
being
care,
over
everybody.
time.
Thank you.
Thank you
Thanks.
so much. I think, Melissa, you're sending out a survey, so
Yep, it should pop up, and if you don't see it, it'll come
that's
by
going to
email.
come through our email, I presume, right? So
Yep, sounds good. Thanks, everyone. Bye.